Warren Buffett received his first dividend check in 1941. He was 11 years old. By the time he turned 60, that single decision to own things that pay you rather than things you hope to sell had compounded into a machine generating more income per day than most Americans earn in a year. He has never called it passive income. He calls it the natural consequence of owning the right things long enough. Most people hear that and assume it only works at Buffett's scale, that you need hundreds of millions before the income becomes meaningful. That assumption is worth examining because the mechanism itself has no minimum. The math works the same way at $300,000 as it does at $300 million. Here's what's strange about that. The strategy isn't complicated. It isn't new. It's been available to any brokerage account holder for decades. So why don't more people use it to actually replace their income? That gap between knowing dividends exist and knowing how to size a portfolio that generates $1,000 a month from them is exactly what this video is about. Without understanding sizing, you can invest consistently for years and still never produce income that changes anything. The balance grows, the paycheck doesn't follow. My name is Alex, and if you've ever watched your portfolio climb without feeling any different at the end of the month, look closely at what that portfolio is actually paying you, because the balance and the income are two separate numbers. And I'm going to show you the exact capital required to hit $1,000 a month and how to choose the right assets to get there reliably. Once you understand how to engineer income from a portfolio, you stop watching a number go up and start running a system that pays you. That shift changes every decision you make from here. The place to start is the most basic question most investors never actually ask. Not what am I buying, but what is it paying me? That's the entire logic behind the passive income dream. Here's the thing nobody actually explains when they tell you to invest for income. They hand you the conclusion without the mechanism. And without the mechanism, the whole thing stays abstract, something other people do, in other financial situations, at other income levels. So let's fix that. The mechanism has a name. It's called a dividend. And once you understand what it actually is, not the textbook definition, but the real-world logic behind it, the rest of this strategy clicks into place almost immediately. Here's how it works. When a company makes a profit, it has a decision to make. It can take that money and reinvest it back into the business. New equipment, new hires, new markets. Or it can distribute a portion of it directly to the people who own shares in the company. That distribution is the dividend. It lands in your brokerage account as cash. No selling required, no timing the market. You simply hold the shares and the company pays you for holding them. Think about what that means for a second. You're not waiting for the stock price to go up so you can sell and lock in a gain. You are collecting a check just for being a shareholder. The asset stays in your account. The income comes to you. Now here is where most people's mental model breaks down. When the average investor thinks about making money from stocks, they picture appreciation. Buy low, sell high. That's the model most financial media reinforces because it's dramatic. Price movements make headlines. Dividends do not. But for someone trying to replace a monthly paycheck, not build a number on a screen, the dividend model is the more direct path. It produces actual cash flow on a predictable schedule. Take a software consultant named David. He's been investing steadily since his late 20s, putting money into a mix of growth-oriented index funds. By his mid-30s, he had built up a respectable portfolio. On paper, he looked like he was doing everything right. But when he actually ran the numbers on what his portfolio was generating in income, the figure was somewhere around $400 a year. Not a month, a year. His assets were growing. They just weren't paying him. That's the distinction that matters. Growth and income are not the same thing. A portfolio optimized for price appreciation is not automatically a portfolio that generates cash. Those are two different designs, built for two different purposes. David had built one thing while hoping for the other. The companies that pay dividends tend to share a common profile. They are established. They have been operating long enough to generate consistent, predictable profits. They are not burning cash to chase growth. Think large utility companies, consumer staples, and major financial institutions. These are businesses whose revenue is largely stable year over year. And because they are not reinvesting every dollar into expansion, they return a portion of earnings directly to shareholders. Currently, the average dividend yield across the S&P 500 sits at roughly 1.3%. That's the broad market. Within dedicated dividend-focused investments, yields typically run from 3 to 5%, and sometimes higher, though higher yields come with their own set of trade-offs we'll get into later. The passive income dream, at its core, is simply this. Build a large enough position in dividend-paying assets that the cash distributions cover your expenses. Your portfolio becomes the employer. The dividends become the paycheck. You stop trading time for money because the assets are doing that work on your behalf. And look, I'm not saying this happens overnight. It doesn't. The build takes time, capital, and a clear-eyed understanding of what you're constructing and why. But the logic is not complicated. It is actually quite clean once you see it, which brings up the obvious next question. How much do you actually need invested to generate $1,000 a month? That number is more specific than most people think, and it depends entirely on one metric, the dividend yield. Understanding how to do that math is where this gets practical. Most people skip this part. They hear dividend investing and jump straight to picking stocks, opening brokerage accounts, and moving money around. That's the wrong order. Before you touch a single dollar, you need to understand one number. Everything else in this strategy flows from it. That number is the dividend yield. It sounds technical. It isn't. Here's the plain version. Dividend yield is simply the annual income a stock pays you, expressed as a percentage of its current price. That's it. If a stock trades at $100 and pays out $4 per share each year, the dividend yield is 4%. For every $1,000 you put in, you get $40 back in cash annually. Not from selling, not from timing anything, just from holding. The yield is the engine size. Before you buy anything, you need to know how powerful the engine is. Now let's run the actual math on the goal. $1,000 a month. $1,000 a month is $12,000 a year. Write that down if you need to, because that annual figure is the target everything gets built around. The question is how much capital you need invested to produce that $12,000, and the answer depends entirely on the yield of your portfolio. Here's the formula. Take your annual income target and divide it by your expected yield. That gives you the required capital. $12,000 divided by 4% equals $300,000. That is your number. $300,000 invested at an average yield of 4% generates exactly $12,000 per year, $1,000 a month, passively. Now let's stress test that assumption, because 4% is not a guaranteed number. It's a reasonable planning assumption based on what dividend-focused portfolios have historically delivered, but the yield you actually achieve depends on what you own. If your portfolio yields 3% instead of 4%, the math changes. $12,000 divided by 3% is $400,000. That's $100,000 more in required capital to hit the same monthly income. The yield difference of a single percentage point costs you roughly 8 to 9 years of additional savings for the average professional. That's not a rounding error, that's a decade. Go the other direction. Say you chase higher yields and land at 6%. $12,000 divided by 6% is $200,000. You need less capital, but you're taking on more risk to get that yield. And we'll get into exactly why that trade-off matters in the next section. The practical planning range sits between 3 and 5% for a diversified, quality-focused dividend portfolio. 4% is a reasonable midpoint. It's the number financial planners commonly use when projecting sustainable income from dividend assets, and it's conservative enough to hold up across different market conditions. Let me give you a concrete example of how this played out for someone. A marketing director named Claire had been contributing steadily to her brokerage account for 11 years. By her late 30s, she had saved just over $280,000. Solid progress, but when she finally calculated her portfolio's actual yield, it came in at 1.1%. Her $280,000 was generating around $3,100 per year in income, about $260 a month. She had done almost everything right. The yield was the problem. Her assets were growing, but they weren't designed to pay her. She didn't need to save more. She needed to reallocate toward assets with higher yields. Same capital, different design, very different monthly income. That's what the math reveals. It's not always about how much you save. Sometimes it's about what your savings are actually doing. The yield calculation gives you the target, $300,000 at 4%. But knowing the number is only half the problem. The other half is figuring out what to actually put in the portfolio to hit that yield reliably, without taking on more risk than necessary. That's where choosing the right investments comes in, and the options are more varied than most people expect. There is a version of this strategy that works, and a version that looks identical from the outside but quietly falls apart over time. The difference comes down to what you actually buy, not the category, not the sector, the specific quality of what you own and why you own it. Start with the broadest distinction. In the stock market, you are essentially choosing between two different relationships with the company. The first is appreciation. You buy shares, the company grows, the price goes up, and eventually you sell at a profit. That's the growth model. It's what most investors default to, and it's what most financial media covers. The second relationship is income. You buy shares, the company distributes a portion of its profits to you on a regular schedule, and you collect that cash without selling anything. That's the dividend model. Growth stocks and dividend stocks are not enemies, but they are built differently and they serve different purposes. A technology company in rapid expansion mode is typically reinvesting every dollar it earns back into the business. Paying dividends would slow that down, so they don't. A large utility company, by contrast, is not trying to double its size. It's delivering electricity to the same customers it had 20 years ago, generating steady, predictable revenue, and returning a portion of that to shareholders. That's the trade. Slower growth, reliable income. What's interesting right now is that the line between those two categories has started to blur. Apple currently pays a dividend. So does Meta. These are not your grandfather's income stocks. Some of the largest technology companies in the world have matured to the point where they generate more cash than they can efficiently reinvest, and so they've started distributing it. That doesn't make them pure dividend plays, but it's worth noting that the category is wider than it used to be. For the core of a dividend income strategy, though, you want to focus on companies with a specific track record. Not just companies that pay dividends today, but companies that have paid them consistently and increased them over time. In investing circles, the companies that have raised their dividend every year for at least 25 consecutive years are called Dividend Aristocrats. Currently, that list includes around 65 companies. Johnson & Johnson yields roughly 3.4% this year. Procter & Gamble sits at around 2.4%. Coca-Cola is near 3.1%. These are not exciting numbers. That's exactly the point. Boring, consistent, and reliable beats exciting and unpredictable when income is the goal. Now, picking individual stocks requires research, ongoing monitoring, and a tolerance for concentration risk. If you own 10 stocks and one cuts its dividend, your income takes a real hit. For most people, that's more management than they signed up for. The alternative is an ETF. That's an exchange-traded fund, essentially a basket of stocks you can buy as a single investment. One purchase gives you exposure to dozens or hundreds of dividend-paying companies at once. The income gets pooled and distributed to you regularly. A few currently stand out for this strategy. The Vanguard High Dividend Yield ETF holds over 500 dividend-paying companies and yields around 2.8% this year. The Schwab US Dividend Equity ETF focuses specifically on companies with strong dividend growth histories and yields approximately 3.6% currently. Then there's the Global X Super Dividend ETF, which targets the highest yielding dividend stocks available and currently sits above 7%. But that yield comes with significantly more volatility and risk. Higher yield almost always means something is being traded away. Sometimes it's growth, sometimes it's stability. Always look at what's underneath the number. ETFs charge a small annual fee called an expense ratio for managing the portfolio on your behalf. For the funds mentioned, those fees run between roughly 0.06 and 0.58% annually. Small enough to ignore at first glance, meaningful enough to factor in when you're projecting 30 years of compounding. Here's the clean version of the methodology. First, identify the yield of what you're considering buying. Second, calculate the capital required to hit your income target at that yield. Third, select quality assets, individual dividend aristocrats, diversified ETFs, or a combination that deliver that yield without requiring you to take on unnecessary risk. That's the investment side of the equation. But there's a layer most people don't think about until it's too late, and it has nothing to do with which stocks you pick. It has to do with the reality of taxes and tracking, and how the timing of dividend payments can quietly work against a smooth monthly income if you don't plan for it deliberately. Nobody talks about this part. The investment content online is almost entirely focused on what to buy and how much you need. The operational reality of actually living off dividend income, the scheduling, the tax treatment, the month-to-month cash flow management gets maybe a footnote. That's a problem because this is where well-designed portfolios quietly break down in practice. Start with the timing issue. When most people imagine $1,000 a month in dividend income, they picture a steady, predictable deposit arriving on the first of every month like a salary. That is not how dividends work. Companies set their own payment schedules. Some pay monthly. Most pay quarterly. A few pay semi-annually or even annually. If your portfolio is built entirely around quarterly payers, you might receive $4,000 in March and nothing for the next 2 months, then another $4,000 in June. The annual total hits your target. The monthly cash flow is a mess. This is not a deal breaker, but it requires deliberate construction. You need to map out when each holding pays, stack the schedule intentionally, and balance your portfolio so that income arrives throughout the year rather than in clusters. Some investors mix monthly paying ETFs with quarterly individual stocks to smooth this out. Others hold a small cash buffer to cover the gaps. Either approach works. The point is that nobody hands you a pre-smoothed monthly income stream. You have to engineer it. A financial analyst named Marcus learned this the hard way. He had built a portfolio of 8 dividend stocks over 6 years, all solid companies, all reliable payers. His projected annual income was just over $13,000. On paper, the goal was achieved, but when he tracked actual deposits month by month, he found that 5 of his 8 holdings paid in the same quarter. 3 months produced almost nothing. He wasn't short on income, he was short on distribution. A simple rebalancing toward more staggered payers solved the problem, but it took him nearly a year to notice it and another 6 months to fix it. Now for the part that surprises most first-time dividend investors. The tax treatment. Dividends are taxable income. The IRS does not treat them as a bonus or a windfall. They are earnings, and they get reported on your return every year. The specific rate depends on what kind of dividends you're receiving. Qualified dividends, which come from most U.S. corporations and certain foreign companies, provided you've held the shares long enough, are taxed at the long-term capital gains rate. Currently, that means 0% if your taxable income falls below around $47,000, 15% up to roughly $518,000, and 20% above that. For most professionals in the target income range, 15% is the working assumption. Non-qualified dividends, which include distributions from certain REITs and some foreign stocks, are taxed as ordinary income. That's your regular marginal rate, which for a professional earning between $80,000 and $120,000 currently sits at 22 to 24%. The difference between qualified and non-qualified treatment on $12,000 of annual dividend income is roughly $500 to $800 in additional tax. Not catastrophic, but real enough to factor into your yield calculations from the start. One practical move worth knowing about is the tax-advantaged account angle. Dividend income held inside a Roth IRA. That's an individual retirement account funded with after-tax dollars, grows, and is distributed completely tax-free. If your timeline allows it, positioning your highest-yielding assets inside a Roth dramatically improves your net income without changing the portfolio itself. You get the same gross income. You keep more of it. The honest summary of this section is simple. The math gets you to the number. The operational discipline keeps the number working. Most people underestimate how much active attention a passive income portfolio actually requires in the early years. The tracking, the schedule management, the tax planning. It's not complicated, but it is deliberate. And once you have that operational foundation in place, the next question becomes how to make the whole system grow faster without taking on unnecessary risk. That's where a few specific tips for growth come in. And one of them, if you apply it consistently from the beginning, quietly does more work than almost anything else in this strategy. There is one decision in this entire strategy that does more compounding work than any stock pick, any yield optimization, or any tax maneuver. It costs nothing to implement. It requires about 4 minutes to set up, and the majority of dividend investors either delay it, forget it, or never do it at all. It is reinvestment. Most brokerage accounts offer something called a DRIP, a dividend reinvestment plan. When your dividend payment arrives, instead of sitting in your account as idle cash, It automatically purchases additional shares of the same stock or fund that generated it. Those new shares then produce their own dividends next quarter, which buys more shares, which produces more dividends. The cycle compounds on itself without you doing anything after the initial setup. Here is what that looks like in actual numbers. Say you hold $50,000 in a portfolio yielding 4%. That's $2,000 in annual dividends. If you spend those dividends, your portfolio stays at $50,000. If you reinvest them, you now hold $52,000 in income-producing assets. Next year, at the same 4% yield, you earn $2,080. The year after, a little more. Over 20 years, the difference between spending dividends and reinvesting them on a $50,000 starting position is not trivial. The reinvested portfolio grows to roughly $109,000. The spent portfolio stays at $50,000. Same starting point, same yield. The only variable is what you did with the income while you were building. This is why the timeline matters so much. Reinvestment needs years to show its full effect. In year 2, it looks like nothing. In year 12, it starts to look significant. In year 20, it looks like a different portfolio entirely. The second principle worth ingraining is diversification, and not just across companies, but across sectors. A dividend portfolio concentrated in one industry carries sector risk that most investors underestimate. Utility stocks, for example, tend to yield well, but are sensitive to interest rate changes. When rates rise, utility dividends become less attractive relative to bonds, and prices can fall. If your entire income strategy depends on utilities, a rate cycle can meaningfully disrupt your cash flow. Spread across utilities, consumer staples, healthcare, financials, and dividend-focused ETFs, and no single sector event breaks the system. Third, pay attention to dividend growth, not just current yield. A company yielding 2.5% today that has grown its dividend by 8% annually for the last 15 years is a more valuable long-term holding than a company yielding 5% with a flat or inconsistent payout history. In 10 years, the grower's effective yield on your original investment, what analysts call yield on cost, will likely exceed the static high yielder. You're not just buying today's income, you're buying the trajectory. A teacher named Sandra started a dividend portfolio at 31 with an initial investment of $38,000. She set up automatic reinvestment on every holding, contributed an additional $400 a month from her salary, and didn't touch the income for 9 years. By 40, her portfolio was generating just over $11,000 annually in dividends. She didn't double her income or take on a second job. She just let the reinvestment run and stayed consistent. The portfolio did the arithmetic for her. Fourth, know when to ask for help. A fee-only financial advisor, someone who charges a flat fee rather than earning commissions on what they sell you, can identify tax inefficiencies, rebalancing opportunities, and structural problems in a portfolio that are easy to miss when you're managing it yourself. The cost of that advice is almost always smaller than the cost of the mistakes it prevents. Fifth, and this one is harder than it sounds, stay patient when the market gets uncomfortable. Dividend strategies are long-duration plays. They underperform in bull markets when growth stocks are surging. They look boring at dinner parties. That's not a flaw. That's the design. The income keeps arriving regardless of whether the headlines are good. The sooner the reinvestment starts, the sooner the compounding does its work. Time is the one input in this strategy that cannot be purchased later, which means the only question left is the one this entire video has been building toward, and the conclusion pulls it together. Here is what this video was actually about. Not stocks, not yields, not spreadsheets. It was about understanding that income and growth are two different things, and that most investors spend years building one while hoping for the other. Once that distinction clicks, the entire strategy reorganizes itself around a single clear question. What is my portfolio actually paying me? The mechanisms that drive this are straightforward. Yield determines how much capital you need. Reinvestment determines how fast you get there. Diversification determines whether the income holds up when conditions change. And patience determines whether you stay in long enough for the math to work. What's worth sitting with is this. $300,000 at 4% is not a fantasy number. For a professional saving consistently for 10 to 15 years, it is a reachable target. The math is not the obstacle. The obstacle is usually the decade of discipline required to get there. Notice, Going forward, what your investments are actually generating in income, not just what they are worth. Those are two different portfolios. One gives you a number to watch, the other gives you a salary. If this reframes how you think about your own investments, share it with someone who's been staring at a growing balance and wondering why nothing feels different yet. Subscribe if you want to keep pulling on this thread, because the next question worth asking is why most retirement accounts are structured in a way that actively discourages income thinking, and what that costs the average investor over a lifetime.